One of the biggest changes in NVIDIA's business model in recent years was the company's decision to move to an annual upgrade cycle on its technology. And that created significant downstream consequences for NVIDIA stock investors and NVIDIA customers, which I want to talk about a little bit more in this video here.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So the latest iteration of NVIDIA's technology, they are calling Blackwell. And in the most recently completed quarter, Blackwell GB300 crossed over GB200 and contributed roughly 2/3 of total Blackwell revenue. The transition to GB300 has been seamless with production shipments to major cloud service providers, hyperscalers, and GPU clouds, and it's already driving their growth. Last year's technology was called the Hopper platform, and that's in its 13th quarter since inception and recorded approximately $2 billion in revenue in the most recently completed quarter. So the implications of this are several. Let me start with the difficulty in upgrading your technology annually when you're selling primarily hardware products. This goes to the research and development, the partnering with manufacturers and suppliers to bring it all together to develop this latest generation technology and ship it to customers and all have it seamlessly integrated to work well without disruption. So by moving from the previous cycle time, which was 2 years, and cutting that in half and moving up to the cycle time of 1 year, had several implications, increasing the difficulty to manage that upgrade cycle. When you're working more quickly, upgrading more quickly, every other facet of the business has to move more quickly. The conversations with suppliers, the conversations with customers, all of that has to work better than it was previously, which increases risk for investors. But then when NVIDIA delivers and it goes through a cycle and it delivers and executes almost flawlessly, that goes to earn a greater degree of trust from investors. As NVIDIA continues to deliver on this annual upgrade cycle, investors become more and more trusting of NVIDIA's ability to execute on this annual cadence. And then from the end user perspective, from the customer perspective that's purchasing NVIDIA's technology, these upgrades make it more and more likely that it delivers better value than the data centers they have that are based on CPUs. And so it makes it more valuable on a return on invested capital basis for the customers. So NVIDIA's latest generation technology is called the Grace Blackwell, as I highlighted. And if you recall, the US government has restricted NVIDIA from selling the latest generation technology to China. But they were supposed to receive permits to sell their H20, which was several years ago when they developed that technology, and it's not anywhere near the cutting edge. And they were supposed to be able to sell billions of dollars worth of those H20 chips into China because the Chinese market has been absent of any of NVIDIA's latest technology. So they would highly demand that older generation technology because it would still be an upgrade compared to what they have right now. But unfortunately, those sales have not materialized because the Chinese government has strongly dissuaded or discouraged Chinese companies from purchasing those NVIDIA chips. So even though NVIDIA technically has the capability to sell the H20 chips to China, Chinese customers have not been purchasing this technology. NVIDIA saying that they were disappointed in the current state that prevents us from shipping more competitive data center compute products to China, and we are committed to continue engagement with the United States and the government in China to try and facilitate an opportunity for China to buy more of NVIDIA's technology. Now, NVIDIA in previous earnings calls with Wall Street analysts has stated that the market opportunity in China right now for its GPUs could be worth $50 billion annually, and that figure will likely increase by strong double-digit percentages over the next 5 to 20 years, 5 to 15 years, depending on the growth rate in each year. If the growth rate is stronger in the earlier years, then the growth rate will not be sustainable for as long of a period. If the growth rate is slower in the earlier years, that growth rate will persist for a longer period. The Chinese market for artificial intelligence is booming, just like it's booming in the United States. Companies like Alibaba, which is the sometimes known as the Amazon of China, has been reporting triple-digit revenue growth rates in its AI segment for several consecutive quarters. And they are investing aggressively to build their data center capacity. And just like in the United States, they say that they have demand that exceeds supply. So the market is open, but Nvidia is not able to compete because of geopolitical tensions between the United States and China. And I see this as a non 0% probability for upside for Nvidia stock investors. Right now, they're basically getting $0 in revenue from China, but there is a non zero chance that there is a deal between the United States and China that opens up the opportunity for Nvidia to sell its chips into the region. Now, it's a relatively small probability given the increasing tension between the US and China, given the increasing trade barriers. But the current administration will not be in forever, and the next administration might take a different stance against China, and that might open up relations between Nvidia and Chinese companies. Now, I've calculated an intrinsic value per share for Nvidia stock at $204, and the current market price at $182 suggests that the stock is undervalued. Even if I apply a margin of safety, which I always do, of between 5 and 10%, the stock still looks undervalued, but not significantly so. When I measured a company using market multiples like the forward price to earnings ratio, Nvidia stock looks a lot more undervalued compared to if I'm using my proprietary discounted cash flow valuation model to value Nvidia stock. Regardless, if it's fairly valued or undervalued, I think Nvidia stock is an excellent opportunity for long-term investors. When a Hall of Fame type business like Nvidia is trading at fair values or below, I see that as an opportunity for long-term investors. And I've been saying that for several other businesses, like, for instance, Microsoft, which is also trading at what I see, in my opinion, a fair value, but I still think it's an excellent opportunity because it's a Hall of Fame business. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.